Welcome to The Explainer. Today, we're diving into exactly what's happening with mortgages right now and why a very specific financial ghost from 2008 is returning to haunt the housing market. If you've been home shopping lately, well, you know it's incredibly tough out there. So today, we're unpacking a trend every single buyer needs to understand before they even think about signing on the dotted line.
And that brings us to a massive question. Why on earth are 2008's risky mortgages suddenly making a comeback? Right now, we're seeing a huge shift in behavior as buyers increasingly reach for a financial tool that severely burned a whole lot of people during the crash. Let's look at the why behind all this.
Part 1, the return of ARMs and the search for relief. Look, it's no secret that standard 30-year fixed loans have spiked recently, which is unfortunately locking a lot of people entirely out of the market. And this sudden desperation, it's showing up clearly in the data. The share of buyers bypassing fixed rates to choose adjustable rate mortgages just hit its highest level in almost a year. People are literally looking for any side door they can find just to get some breathing room.
So what's actually drawing them in? That brings us to part 2, the lower payment appeal, or simply the allure. Just as a quick refresher here, an adjustable rate mortgage, or an ARM, is essentially a home loan that tosses you a heavily discounted introductory interest rate right up front. But true to its name, that rate eventually changes based on market conditions. It's not a permanent 30-year guarantee, right? It's just a temporary discount.
When you stack these two up against each other, the psychology makes total sense. On one side, the standard 30-year fixed is super safe, but man, right now it is incredibly expensive. On the flip side, the ARM introductory rate is noticeably lower. Put them head-to-head, and that immediate financial relief is seriously tempting.
It really boils down to one incredibly powerful proposition: a lower payment for the exact same house. For those first few years, an ARM shrinks your monthly bill enough to actually get you moved in. It gets you the keys and makes your budget work today. And honestly, it sounds like the absolute perfect solution.
But here comes the hidden trap inside this financial Trojan horse. Part 3, the reset rate trap and the twist.
Here's the catch. That low rate is strictly temporary. You get your sweet discount for years 1 through 5, and it feels fantastic. But then you hit year 6, the reset. Usually after 5, 7, or maybe 10 years, boom, the intro period evaporates. From year 7 on, you step out into complete market unpredictability, and your rate resets to whatever the broader market dictates.
If interest rates have climbed by the time your reset date actually arrives, the math gets absolutely brutal. We aren't talking about your payment going up by the cost of a couple of lattes here. It can jump significantly, sometimes by hundreds of dollars, literally overnight. Your household budget suddenly has to absorb this massive shock.
And this is exactly what caught so many folks completely off guard during the 2008 crash. As the saying goes, they could afford the intro rate but not the reset. Buyers basically built their entire financial lives around an artificially low bar. So when the higher reset finally hit, they were totally trapped. Now, ARMs aren't inherently evil or anything like that. That leads us to part 4, playing the ARM safely, the reality check.
Think of an ARM kind of like a power tool. You just need to know exactly how to handle it. You need an exit strategy playbook. If you take on an ARM, you absolutely must execute one of 3 moves before that reset kicks in. Either move to a new home, refinance into a fixed rate, or pay off the loan entirely. If you're highly confident you can pull one of those off, an ARM can genuinely save you some serious money.
Because really, the true danger here is treating an ARM like a fixed-rate loan. The absolute worst mistake you can make is just blindly enjoying that low payment for 5 years without an active, solid plan for the end of the intro period. You simply cannot put this mortgage on autopilot. You have got to stay awake at the wheel.
So if you are house hunting right now, you need to protect yourself with 2 essential steps. Step 1, ask your lender the exact date the rate adjusts. Step 2, ask for the cap. Basically, how much could it realistically increase? You've got to arm yourself with the cold, hard math before you fall head over heels for a deceptively low payment.
So, knowing what you know now, the big question is, would you risk dancing with the financial ghost to secure your dream home today? Let us know in the comments below if that upfront discount is really worth the long-term uncertainty to you. Thanks so much for joining this explainer, and be sure to subscribe as we keep decoding the housing market for you every single week.